Thanks, Stanford. Good morning, everyone. On behalf of Asian Markets, we welcome you all to the 4Q FY19 earnings conference call of LG Equipment Limited. We have with us today Mr. Jairam Varadaraj, Managing Director, representing the company. I request Mr. Jairam to take us through an overview of the quarterly and yearly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Good morning, ladies and gentlemen. As always, it's a pleasure to be with you on this call. Following our standard, I will take you through the quarter numbers, and since it's a complete year, I will also talk about the full year. For the quarter comparison, I have just included Pulford's total EBITDA rather than the individual P&L to explain a reconciliation between the current year's performance of the quarter and previous year. So the previous year's EBITDA, which did not include Pulford's, is 506 million, and the current year's quarter, which EBITDA, which includes Pulford, is 626 million. The EBITDA should have been 777, considering the increase in sales and the decrease in the material cost. So the gap really is 151 million that we should have earned. Now, the biggest cost contributor for that 51 million is our employee cost increase of 127, of which 48 million is in India, which is the normal increment that we process. Close to 40 million is exceptional increase in employee cost as part of our initiative in the US, and partly because we've started the initiative in Europe, we have gotten certain people on board, and those costs are also reflected here. So overall, I would say it's been a good quarter. If you remove out the exceptional items, the total exceptional items come to close to about 100 million. So if you add that back to our EBITDA, we've got a healthy growth in our EBITDA. For the quarter, without exceptional items, we've got a 48% growth in our EBITDA for a 14% growth in the top line. So I think the leverage has been pretty positive when you remove out the exceptional items. Going to the full year, again, keeping only the EBITDA of Pulford's into it, last year's EBITDA without Pulford's was 1,761 million. This year's EBITDA, including Pulford, is 1,929 million. The EBITDA should have been 2,858, considering the increase in sales of close to 16% and a marginal decrease in material cost to the extent of 141 million. Here again, we looked at the reconciliation. The employee cost contributes to about 455, of which India is 195, which is normal. I would say the exceptional increase in employee cost is close to about 55 million. And the increase in fixed costs, which are exceptional in nature, is about 200 million. So if I add these exceptional costs back into our EBITDA has grown 29% for the whole year. 27% for the whole year on a growth of 16% on the top line. We could have done better. The first few quarters of the year, we did not really push certain price increases through. As a consequence, our margins dropped during which we came up. We did better in the fourth quarter, and as a consequence, we see this. So we have corrected these in the current year, so we expect that the contribution margin in the current year to be better than last year. So really the summary of our performance for the quarter and for the year. A little bit on at a business level, India continues to be 50% of our revenue, but the growth in India in terms of percentage, we grew far better in the U.S. The percentage growth in the U.S. was much more. We continue to see good traction there. Our initiative that we spent a significant amount of time and resources. We spent almost 6 months last year in building the process, building the team. We expect to see some good traction in the coming year from the U.S. market. In India, the economy kind of took a pause. Now with the political results out and there is a general euphoria in terms of a positive sentiment, we expect the market to grow. But even without the markets growing, we have identified areas where there are opportunities for LG to grow even in India, and we're going to focus and drive on those. By and large, our variable costs, including material costs, are in reasonable control. We don't see any surprises. And like I said, we have corrected our prices to reflect past commodity price increases. So that should kick into our bottom line. Increase in people cost, we don't see any big increase in headcount in India. We expect to see the normal increase in the range of 8 to 10% in compensation, which is the industry standard. Europe, we have started, like I explained during the analysis of the quarterly performance, we have started our initiative in Europe. We are in the middle of building the entire team. We have made a pretty ambitious plan for Europe. I will explain more about it in the next quarter's call, where we will have greater clarity in terms of where we are in terms of building the team. Unlike the U.S., where we went in through an acquisition of a distribution business, this I'm talking for the industrial products, and then grew the independent distribution network. In Europe, it will be, we will start with building the distribution. We have identified select geographies rather than all of Europe, select geographies that we want to focus on. We are in the middle of identifying talent for each of these geographies. We are looking at organic growth primarily. If there are inorganic opportunities which are currently not visible to us, we will pursue them. But right now, the entire focus is on building the team, and that's really where our cost is going to be for the next year. So there is going to be a cost impact of, again, an exceptional kind that comes out of Europe. So Australia continues to be strong. We are looking at growing it organically. There are some inorganic opportunities that are being presented. We are not clear how we are going to take it forward, but that is there. But they are not significant in value. At the appropriate time, I will come back and talk about that. So this is really the synopsis. Overall, I would say the company's position is getting stronger. As part of our initiatives, we are getting greater traction in some of the markets. As investors, you'll continue to be looking at when we are going to start realizing the margins that should come out of all these initiatives and the growth in the top line. You will see that the consolidated profits are actually increased quite healthily in this year, and we continue to believe that the consolidated profit will continue to improve, but nowhere near the kind of top-line growth that we are getting outside India. And that is because of these exceptional items that are invested because of the initiatives that we are driving. We will continue to do these initiatives for the next 2 to 3 years at least. And therefore, even while, like we presented in the investor meet, it will be a hockey stick kind of a progression in our profitability. And we are on track towards the hockey stick that we had projected during the investor meet. Now, if you look at our net debt position, we are right now at, without looking at the Pulford's acquisition, we are at 42 crores. If we include the debt that we had taken up for Pulford's, we are at 98 crores. The current debt of the company is at around 115 crores. I apologize for the wrong number. We have reduced our debt by 422 crores.
420 million.
42 crores, sorry. 42 crores. And if you removing Pulford's from that reduction, we have reduced our debt by almost 99 crores. So this is the summary, and I'll be happy to take any questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Congrats on a good set of numbers.
Hi, Ravi. How are you?
Great, sir. How are you, sir?
Good.
Sir, we have seen pretty decent growth in the domestic market in spite of when we speak to channel players in the capital goods space. Fourth quarter hadn't been that great a growth for many of the equipment players, but still we have clocked 12% growth. Where is the growth coming from? Is it because of market share gains that we are doing? And is it that infra-related equipment sales hasn't done well, but the other divisions are doing well? And going forward, can we maintain the same 15% kind of growth in the domestic market over the next 2 to 3 years, given the kind of visibility that is there because of the current government?
So, I don't think there is any one sector that has grown, that has contributed to this growth. But we should be also honest that, the fourth quarter is always a big kind of an orgasmic exit for the financial year. So there's a bit of that effect in the fourth quarter results. But even normalizing for that, we have grown well in all the sectors. I can't say that there is any one sector that has contributed more than the other. As far as whether we've gained market share, you need to go and talk to our competitors and come back and tell me, because I really don't know their numbers. I know their financials to the extent that they have published, but I don't know their quantities, so I can't really say.
Okay, because
in terms of our ability to grow at 15%, it's certainly there. Like I said, there are segments in the market that we have identified that we need to get have a bigger presence. We are focused on that. That should yield us some results. We've got new technologies that we have launched that should give us some results. And overall, if the economy grows, that should give us the tailwind to make that 15% growth.
Okay. And in terms of the international operations, so basically, US we have done well. Is there any impact of this trade war? And if you can share the key top line numbers and the PAT numbers, PBT and PAT numbers for Rotair, patents and
I don't have it with me right now, Ravi. I think we will post it as part of our results. You should get it soon. Right. I don't have the numbers in front of me.
Okay, but is there any impact that is going to be there in U.S. operations because of this trade war, or is it like we have very low market share, so it can keep?
I don't think if you look at the posturing of the general GSP kind of preferences that U.S. is going to withdraw, the extent, the size of that export is quite small compared to what is happening with China. Besides, there's still an attempt by the two countries to come to some sort of an understanding. So as of now, there is no impact. Even if there is an impact on our pricing, there will be some margin pressure, but we are already taken cognizance of that, and we are working on certain projects to compensate for that if at all it happens.
Okay. And as you had mentioned pricing, so we are in the domestic market at a discount to many of the MNC brands. Can it get closed over the next 1 to 2 years? I mean, is there a headroom for price increase going forward for us in the domestic market?
Ravi, if you have some data on this, I'd love to have it so that I can put it in the face of our sales guys to tell them that there is a huge gap between us and the other MNC brands in India. Because when I push for prices and our sales and distribution channels come back and say, oh, we are already at a very high level. So if you have some data, I would love to have it.
I mean, these are all anecdotal evidence that dealers, etc., were telling. So that's why.
Okay. Was it the dealers of our competitors who are saying that we are low?
Yeah. So.
Okay. Good. So I'll convey this on to our salespeople.
Yeah. And this employee cost and the other costs you were telling, one-off cost expenses were there.
Yeah.
I mean, employee cost anyways would be sticky, right? So what is the one-off in that? And how much blended employee cost increase can be there next year at an overall company level? And is there really a one-off expense which is not going to occur next year in the other costs? Or is it like these are all general spends that we have done internationally and that would also be sticky?
Well, the one-off cost on people's side is about headcounts that we added in the U.S. primarily for the purpose of our initiative that we ran with BCG. So, to that extent, it is one-off, right? But for the year 1920, that cost will remain, but the benefits coming out of the initiative will also come along with that in the top line. Yeah, but for 18-19, it stands out as one-off because the commensurate gain on the top line did not get realized in 18-19. Now, in terms of general increase, like I said, we are increasing our headcount in Europe in 1920. So to that extent, there will be an increase in the, again, one-off cost of people cost in Europe, which will not immediately produce results in 1920, but we'll start seeing results in 2021. So that is other than that, I don't see any additional one-off costs in other regions where we are operating. Now, the other one-off cost that we expect is also by virtue of this PF ruling that has come in the Supreme Court. We have made some provision in ATS, which is to the extent of about 14 million, but that is because an order and a claim and a demand notice has come. In LG, we have not got an order or demand notice. We don't know how the government is going to clarify because we don't know whether it's retrospective. Is it retrospective from September 14 or is it retrospective for 8 years or is it retrospective from 1952? Nobody really knows. So we have just created, there is a possibility of a cost. We don't know what that's going to be. This year, it has been 14 million for our automotive equipment business. So that comes under the one-off kind of a category.
This is regarding what, sir? This,
PF ruling was made by Supreme Court in February of this year, which said that all allowances that should be added for the purposes of calculating PF. Earlier, it was only basic and DA.
Okay, I will come back in the queue, sir.
Yeah.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Yeah. Good morning, Jay. Congratulations.
Good morning. How are you?
Very well, thank you. How are you?
Good.
So my first question, Jay, is what is your reading of the recent M&A in the industry, Ingersoll Rand and Dresser-Rand? What in your view...
You mean Gardner Denver, not Dresser-Rand.
My bad. Yeah, Gardner Denver and Ingersoll Rand. How do you believe the industry will react? Do you believe over time that leads to better pricing environment in the industry?
I don't know about pricing, but any consolidation is good for the consolidated entity in terms of taking cost out for them. But also any consolidation provides opportunities for the other players in the market, because the same synergy that takes cost out is the same synergy that presents opportunity. For instance, you'll take cost out by consolidating your distribution network. Now, when you consolidate distribution network, distributors become available for other companies' brands. So there are some things that are beneficial. There are some things that are opportunities for the others. So same thing with talent. When two companies merge, they're going to compress, collapse positions, which means talent becomes available in the market. So that's an opportunity for companies like us, which are growing, and we're looking for talent. So it's a mixed bag, and it's certainly from a number two position, which was 1.8 billion. Now you're going to have our number two, which is about 3.2 billion, which is certainly a more symmetrical structure. So number one and number two, the size has been reduced, but still number two is going to be, even after the merger, 40% smaller than the number one. And the number three is still going to be a very distant number three. So opportunities for LG to maneuver into this range. Okay, CK2, the meaning of CK2 literally will no longer be relevant, because it's difficult to reach that position within the time frame. But CK2 for us as a directional target, as an aspiration, continues to remain.
Yeah. The second question is continuing to what Ravi kind of asked, and when we also check with and meet some of the competitors, not the dealers, their view is that the LG's products are actually at a 15 to 25% discount on an apple-to-apple comparison, especially on the screw compressors, which goes on the industry side. Would you actually buy that, and do you see a headroom for expansion of these screw compressors?
Well, there are always opportunity. I wouldn't put this as a very strategic issue, but this is a key operational factor. There are definitely opportunities for us to improve our margins. We continue to do it. There is a transformation that is happening that is not going to happen in 1 year. We are transforming from customers' perception. We transformed ourselves from being an Indian company at a product level to a global company at a product level maybe 4 or 5 years ago. But we are still not transformed the customer's perception that we have moved from an Indian company to a global company. Now, that doesn't happen by just advertising and a turn of a switch. That transformation will happen through a whole series of activities, including how our salespeople talk to our customers, how our distributors talk to our customers, how the customers experience us, the quality and of the experience in social media, the touch points. It's a combination of multiple things, and that's the transformation we're going through. We hope that progressively the transformation will yield us the kind of price that we deserve to have from the market.
Yeah, that's all. My last question is, so Cummins India, in his earnings call, they are expecting 50% growth in the water well segment. So it'll be helpful to get your view and how large is water well for us.
I don't want to give the specific numbers for the water well business for obvious reasons, but I agree with you. There is a uptick in the water well market compared to last year. We started seeing the uptick even in the last quarter. The good thing is we are positioned very well compared to where we were 2-3 years ago. Our product has been well accepted. Performance of the product is in fact better than the best in the market. We had a setback a few years ago, and the hangover from the setback is the reason why there's inertia in the customers to consider that. But that inertia is breaking down quite significantly. So we should be riding that market well. Is this uptick going to sustain itself in the next 12 months? We've got to wait and see. But if it does happen, we are well prepared.
Yeah. Thank you so much for taking my questions.
Yeah.
Thank you. The next question is from the line of Ishit Sheth from Anvil Shares. Please go ahead.
Hello, sir. Good afternoon. Sir, if you could just give us a growth number geography-wise, like how much did, say, US grow for FY19, and how much was Europe and the major geographies that we are in?
I prefer not to give that level of granular data. It is not in our interest, but you will have whatever the statute, the legal entities that are there, those numbers will get published, so you will get a sense from there. But the regional sales include something beyond the legal entities, and those numbers are, I would prefer that we don't talk about that.
Sure. Okay. Sir, also on a question on the employee cost at the consolidated level and the standalone, as you mentioned, that after this exercise that we had, the cost are likely to rise by normal rate of 8 to 10%. But what about the consolidated employee cost? How much would they rise? Because still we are in that phase of investment because of the BCG program. How much are they likely to go up for the next year?
I don't see a big increase in employee cost in the US because that has been done.
Okay.
That's been absorbed, and those are the exceptional costs that I talked about.
Sure.
They will continue. They are not going to go further, and we expect that the investment into that cost will start seeing some results in 1920. But like I was saying, we are starting our initiative in Europe, and towards that end, we are creating a team there. On a steady-state basis, that team is going to cost us close to about 4 to 4.5 million euro. So in rupee terms, that's about 36 crores. Now, is that 36 crores going to come in one shot? Probably not. It is going to, even if we try hard, we probably won't be able to recruit everyone in 1 year. So progressively over the next 2 to 3 years, we will hit that level.
Sure.
Like I said, I will be able to tell you in the next quarter specifically what will be the impact in 1920.
Okay. And sir, one question I had was on our oil-free compressor range that we were to launch in the Hanover show. I'm assuming it's already launched. So what is the feedback that we are getting in terms of this product, and how do you see this shaping for LG over the next couple of years?
Well, the feedback in the show was quite was outstanding. Both from customers, distributors, and competitors.
Sure.
Now, if you really look at it, our sales and marketing effort for this product has happened only in India. So we've got reasonably good installations in India. And the good thing is there are repeat orders coming in from customers, which for me is the ultimate indication of the acceptance of the product. Now, we are in the middle of putting together a program of taking this product globally.
Sure.
Now, again, we will be focusing on strategic markets to push this through. Unlike oil lubricated compressors, oil-free compressor is not, it's not that easy to get into the market. So there's a lot more that needs to be done, and we are in the process of thinking through putting those systems in place.
Okay.
I expect that in 1920 we will see some good results from this product in India and some initiation of good market development in the other strategic markets. In 2021, then we can start seeing more growth for this product in our strategic markets outside India.
Okay. So, but directionally, if I were to ask, like how the overall industry is shaped up in India as well as in US and for us also, that majorly, out of the overall compressor sales, most of it is into the oil-flooded compressors. Now, if I were to look at, say, maybe 4 or 5 years down the line, do you think this line of product can probably shift that balance in favor of oil-free for us and for the entire industry?
See, our goal, like I've explained in the past, in terms of our roadmap, our goal is to drive technology so that all products are oil-free.
Okay.
Now, what we have launched, see, oil lubricated is low cost, is very efficient.
Right.
Oil-free is high cost and less efficient.
Right.
You got to remember that life cycle, energy consumption is the biggest life cycle cost for a customer. So, in order for both these two segments to converge into one, the oil-free compressor should become as efficient as an oil lubricated, and it should become much lower in cost. Yeah. Now, that's the direction in which we are working, and this technology, or this product that we have launched, kind of is closer to oil lubricated, both in terms of efficiency and cost, but still not there. We are probably around 5 to 6% off.
Okay.
And that's really what we are working on. Now, we are hoping that in the next 1.5 to 2 years, we will be able to achieve it. And if we do, then it's a bigger revolution than what we have launched just now.
Correct. So this 5 to 6% that you spoke about, is the total life cycle cost or the upfront cost?
The specific efficiency.
Oh, okay. And specific efficiency.
Efficiency difference of 5 to 7%.
Okay, sure. And do you see any kind of development from our competition globally on this kind of a product line?
We haven't heard of it. I'm pretty sure they are working on things like that, because everybody's dream is to make all compressors oil-free.
Sure.
But we haven't seen any evidence of it yet.
Okay. Thank you, sir. I'll get back in the queue for more questions.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, very good afternoon, sir.
Hi, Manish. How are you?
Great, sir. Thank you so much. Sir, just to clarify, in your initial remarks, you said India contributes 50% of revenue. So you were probably including the ATS LG numbers and were you referring to that?
No, I'm looking at the compressor business, right?
Okay.
As a compressor business, India is about 50%.
Oh, okay. Okay.
You won't be able to see all that very specifically because if you take the standalone and consolidated, on the standalone you have sales to subsidiaries.
Correct. Yeah. So that implies that exports have grown quite well this year to the subsidiaries, because otherwise we were at 60-40. So I was just trying to.
We were at around 55-45. We were hovering over that, around that. So when I say 50-50, don't hold me.
No,
hold
sure.
neck to exactly 50. It may be 52 or 53, 47 in that range. Yeah.
Sure, sir. And on the cost side, as you were referring that now most of the investment related or probably front-ending cost in India and US has been done with, and Europe is where you are looking for. So ideally, going forward on margins front, if you probably look at India, last year India had probably some one-off cost because your other expenses have gone up by 23% as compared to your revenues of 17%, and your EBITDA margins have been fairly stable at 12%. So now going forward, sir, if you look at most of the cost in terms of employee cost and other development cost have been incurred in India, plus in US also you have kind of gone through that cycle, then in that case, sir, even if you probably have some higher fixed cost from Europe, with decent top-line growth, you should still be able to grow your EBITDA margins for FY20, right, sir?
Absolutely. So this is something that we presented during the investors meet, but it's not going to touch that final number that we had presented in one straight line.
So directionally, sir, that at least we should now, because India sales, if we see growth and the fixed costs are more or less likely to remain where it is, then ideally if India and US margins start looking up, I think directionally we should probably see a decent improvement in margins if revenue growth supports.
You've seen it already in the fourth quarter.
Yeah.
And you're all identified. If you remove all the exceptional costs that I've talked about, which are primarily in the U.S., you will see that India, now the other fixed cost increase that you are referring to has two major elements. One is a cost that was paid on behalf of the U.S.
Okay.
So it's not an India-related cost. And the second thing is that we changed our accounting policy on R&D material that we buy for R&D, right? So that is that cost is a significant cost because we were writing everything off. We're going back to our earlier stage-based write-off. I mean, up to a certain stage, we will carry it as stock. Beyond a certain stage, we will write it off, right? So that was a significant amount that has come in. So it's not a real impact on profit, it's a cash flow issue, right?
Sure.
So India, if you normalize for all that, India has grown, the profits have been pretty good, right?
Sir, in Q2, you had mentioned that there was probably 9 crores pertaining to one time. So if you can give a perspective that for entire year, how much would you attribute this one-time cost in the standalone and then Concall? I'm not talking about employee cost, but
I don't have the standalone thing in front of me. I've looked at only
so at Concall level, how much?
Consolidated, I told you the exceptional items at a consolidated level have close to 255 million, that's 25 crores, of which about 55 crores is people related and 200 is about the initiatives that we have run. One is the initiative in the US, and the second is the R&D cost that I explained to you. The third is the motor development, which is one time, where we had some design fees. Then the fourth is the Hanover show expenses that were there. So all of them are not going to be there for next year. Well, sure. Some of our initiative costs in America will continue. Marginally, they will still be there, but it's not going to be the entire significant number.
Sure, sir. And you also, in your initial comments, mentioned that you would continue to see strong growth momentum in U.S. markets. Basically, despite being on a low base, the percentage of growth will continue to be higher than the India. So basically, you are alluding to fact that even probably apart from U.S., even Australian markets and other geographies, overall as a percentage will probably see a higher growth rate.
Yeah.
Okay. And
U.S. for sure, because we have now supplemented our low market share position with a very strong strategic initiative. So those things should start seeing results for us. Australia, our presence in Australia through the acquisition has increased our market share. So
sure.
To that extent, I don't think Australia will grow at the same. It will definitely grow at a big percentage, but it's not going to grow at the percentage of the U.S.
Okay. And sir, when you are referring to U.S., how has been now outlook for patents? Have we kind of managed to probably turn it around and probably see benefits coming in FY20 and 21?
So one part of the initiative was also patents.
Okay.
So a lot of process changes, a lot of new leadership, new talent that has been brought in.
Okay.
So I don't want to comment on the results. I would wait for the next, probably by end of the second quarter, we'll be able to tell you clearly.
Okay. And I had one more question. Apart from U.S., which other markets like Middle East and probably South America, and which other markets you probably see growth coming in for us, sir?
Well, South America, the only country we are in Brazil, is in a tough situation right now. We are in a holding position in that country. We have faith because of the natural resources and the basic capabilities in that country. We believe it has possibilities in the future. So we're just holding there. We are not creating any investment. We're cutting down costs and just holding. So I don't expect anything significant coming out of Brazil. Middle East, especially the UAE, we have decided to go direct. We're building our team and our process even as we speak. So I expect that there will be some positive contribution from that market. But again, we are talking in terms of scale, value, it's nothing significant to talk about.
Sure, sir. And last question on India now, how do you see, are we probably, now with elections behind, probably we were seeing that there was some slowdown in the month of April and May. Did you experience similar thing, and do you expect that probably growth momentum to pick up in near future, or it will probably take some more time?
I don't think it's going to just change in a month, the sentiment. I mean, probably people will buy more biscuits and probably candy, but compressor takes a little bit of time for them to think and then buy, right? So for them to come around, create capital capacities and capital investment, sentiments have to drive that. Sentiments are positive, but when will those sentiments convert into actual capacity creation investment? We have to wait and see.
But this you are referring more on a project side, But on other side,
I'm not even talking. Compressor is a capital equipment, which means either it's a new plant or a balancing investment to increase capacity of an existing plant, right? So the decision to do that is a function of one is sentiment and the other one is actual demand. Right. So if the sentiments are positive, then people will do it, and then on the basis that the demand is going to pick up. But right now everything is, it's not just April and May, but the whole thing started going slow from November, December onwards.
Right, sir. And really last question on Europe, the hiring which you are planning, this by over what duration you expect that you should complete that process? Would it probably last over 4?
Like I said, Manish, I'll be able to give a more coherent answer by the next quarter.
Okay, fine, sir. Thank you so much.
Thank you. The next question is from the line of Jasdeep Walia from Infina Finance. Please go ahead.
Good afternoon, sir. Thanks for taking my question. So what has been the growth in exports from India in in the last year, sir?
You need to take this offline. I don't have that number in front of me.
Got it, sir. And sir, in US, when you were mentioning exceptional costs, you said that you had some initiative in US in last year. What was the nature of this initiative? Is this expense related to some consulting exercise that you did?
Yeah, I think you are new into the call. We've been talking about this for the last almost 3 or 4 calls. This is an initiative that we've been working with BCG to build new go-to-market processes and systems.
Got it.
So that's the cost relating to that.
Got it, sir. Thank you. That's all from my side.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Kiran Naik from Modi Fincap. Please go ahead.
Thank you, sir. Thank you, sir, for giving me an opportunity. Sure. Hello. Yeah. So, what is your market share in the industry?
That's a good question because it's the most elusive number. Nobody shares data. So it's very difficult to say what's the share of the market. But we can confidently say we are a very close number 2 in the industrial compressor business. But if you ask me to put percentages, that would be a very difficult one.
Okay, sir. So Atlas Copco is a competitor?
Yes.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Arun Varsi from Parry, Washington. Please go ahead.
Good afternoon, Jay.
Hi, Arun. How are you?
Yeah, good. I'm doing good. How about you?
Good. Head above the water, as you can see.
Yes. Jay, I just have one basic question. I missed out on the total debt number, actually, the gross debt number.
Okay.
Can you just give me that?
So our net debt at this point in time is 115 crores.
Okay. No, I would prefer to have the gross debt number, Jay.
Gross debt is 237.
Okay, 237.
Yeah, you need to keep in mind that some of our borrowing strategy is also from a cost point of view is to create debt here and then use that as a collateral deposit for debt outside. So I would say net debt is the right number, 115.
Okay, got it. Okay then, thanks, Jay. And what's the capex plan for the next year actually, for F20?
Well, the new capex that we are planning is around, I think is around 30 crores, but there will be some carryovers expenditure from commitments made from this year to the extent of maybe 15-16 crores. So maybe about 45 to 50. But Arun, I'll tell you, every time these guys give me a capex number and they don't spend the whole thing. So you can be confident that...
I've seen that as a history. Yes.
Yeah. So you can be very confident that you will have spare cash.
Got it. Okay then. Yeah. Thanks, Jay. Yeah, thanks. Yeah.
Thank you. Participants, to ask a question, please press star 1.
Jay, Kamlesh here. Just a couple of points. What was the spare sales for the year, if you can just share in terms of the overall share and how has been the growth there?
The total share of sale of spare parts globally, I don't have a number, Kamlesh, but our sale of aftermarket, I wouldn't even call it, I don't want to go into parts and service separately. Our aftermarket in India has grown quite strongly. Today, I would say our percentage of aftermarket is about 25-26%.
Any ballpark range of global markets, sir? How it would have been for our revenues here?
I don't have it. We can take it offline. We can talk about that.
All right. And any color on the railway side of the business? We are seeing some big ticket investments are now being planned, already underway. So how that business must have done for us?
It is good. I mean, we grow as long as the intercity, the main government-owned railway business grows. Like I've said in the past calls, our presence in the metro is very, very low. It's almost, you can say, zero, right? That's really the focus for us. It's not that easy because the suppliers of all the electrical multiple units that go into metros are all European companies, European, Korean, and Japanese companies, and they have got different brands of compressors that are homologated, so they don't accept our machines, even though the performance of our machines are far better. So we are looking at certain opportunities like in the old metros like Calcutta or Delhi, where they're coming up for overhaul or replacement. We're looking at those opportunities. We're also talking to some of these EMU manufacturers to get our compressors homologated, but it's going to take time. So I would say railways is okay, but metro is where we are quite weak.
Okay. Right. Any more questions, Stephen?
Yes, sir. We take the question from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for this opportunity again. Jay, can you speak about the infrastructure side of the business? Some color on how large will be, and we are seeing new companies in the recent past like Sany and Lugong. Are they actually looking for our products, and how do you see growth in that segment?
What's the name that you mentioned? I didn't get you.
The likes of Sany, Lugong.
Okay. We've not heard of them. They are making those cranes and material movement stuff. We've not really encountered them. So they're not in our customer list. Infrastructure had a tremendous growth for about last 2-3 years, but it softened out for two reasons. One, the budgets for roads got exhausted and it was not renewed. Second is the banks really squeezed up on financing, and many of the infrastructure stuff like roads or dams or airports or ports, the construction is all done by small to medium-sized contractors, and they are their access to capital got curtailed, because of which the overall market started softening a little bit. So I'm hoping that in 1920, on both those dimensions, the new budget will bring in more investment into infrastructure, and I'm hoping that the banks kind of loosen their purse strings a bit.
Who would be the key OEM suppliers, OEMs where LG is supplying on the infrastructure side?
We don't have a big OEM. We are supplying directly to the contractors and end users.
Okay, sure. Yeah. Any plans that are you working of getting in the construction equipment space where the compressors are used inside the construction equipment?
No, that's a diversification for us. That would be a distraction for us. We are focused on compressors and trying to build that market. So we will not get into those kinds of products.
No, my question was like the compressor which goes inside a construction equipment, like likes of JCB may be making, supplying to the likes of JCB.
Oh yeah. We are doing that, but it's not a big. There are people who make drilling equipment who are our customers. But when you asked me OEs, I was talking more from the point of view of the size of the OEs. The size of the business is more direct. The size to customers like Schwingstetter or some of the drill manufacturers, that's very small as a percentage.
Okay. Can that over a 5-year basis become a reasonable size and you're making as a focused activity?
I don't think it is small because we are not focused on that activity. The demand, like for instance, if you look at Atlas Copco, they have their own drilling equipment business and they put their compressors and drilling equipment together. Then you have companies like Revati Equipment. They are customers of ours, but it's not like they sell a lot of equipment there. Then there are small companies, small to medium-sized companies who make drilling equipment. They're all customers of ours. So the size is not very big. It's not because we are not engaged in that market that our revenues are small. It's just that market itself is small. And there are big players who have their own compressors. Then there are small to medium-sized players who buy from us.
Okay, sure. Yeah. Thank you so much for taking my questions.
Thank you.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Sir, just two bookkeeping questions. One is the depreciation in subsidiaries have gone up. So is it entirely due to Pulford acquisition or is there anything else, sir?
It's the intangibles in the Pulford's acquisition.
Okay. So we are taking a quarterly provision on that.
Yeah, the depreciation is done on that. Except the residual goodwill, there are the other intangibles that we do. On the intangibles, we depreciate. Right?
Sure. And second question on the tax rate has come down at India level from 33% to 29.7%. So is it a function of change in R&D accounting, sir?
No. R&D is only on a books level. That is not the main factor. Tax lowered from 30% to 25% for our ATS subsidiary. And tax lowered in Italy, right? And deferred tax asset of 20 million recognized in Elgi, Australia for accumulated losses.
Okay. So we'll probably revert to normal taxation going for FY20.
No, we still have some losses in Australia. We have some losses at patents. All that we will be able to, we'll be absorbing it.
Sure, sir. Thank you so much.
Yeah.
Thank you. Participants, to ask a question, please press star, then 1. Participants, to ask a question, please press star, then 1. As there are no further questions from the participants, I now hand the conference over to Mr. Kamlesh Kotak for closing comments.
Thanks everyone for joining for the call. Special thank to Mr. Jairam Vadraj for providing us insight about the company's business and financial performance. Any closing remarks, Jai?
No, thank you for organizing this, Kamlesh, as always, and appreciate your engagement with us. I don't have anything specific. I look forward to the next call.
So with that, we conclude the call. Thank you and have a good day.